Hi, everybody, and welcome to Realty Success. We are so excited today. We've got a great guest, and you're going to have a lot of fun with us. My name is Brooke Bryant. I'm one of the hosts of Realty Success. I'm a realtor in the Charlotte, North Carolina area, and I work a lot with investors and home sellers, but love working with first-time home buyers. I have a book you can find on Amazon, The Ultimate Guide for First-Time Home Buyers, and I'll have a link to that at the end of the show. Joining me today is the beautiful Regina Brown. Regina, please say hello to everybody.
Thank you so much for having me today. I am Regina Brown. I am a luxury realtor here out of San Antonio, Texas. So looking forward to some great information today. And over to you, Scott.
Well, good morning and hello. What a great today. Today is going to be so much fun. I'm so glad you're tuning in. We're getting to talk about one of my favorite topics, well, real estate. And how do you win it? And that's going to be the spirit, I think, that we get to explore today together. I think we're going to unlock a lot of fun things, and we're going to get a current climate of how to win in such a changed environment. I'm here in Los Angeles of everywhere fun. I'm a mortgage broker. I'm one of LA's Blue Diamond mortgage brokers. And well, that's a lot of fun. That allows us to access solutions in a market space, often before they become market spaces solutions. And how we achieve that. Well, you know what I've learned? It's fun to win. That's my hashtag for 2023. It's fun to win.
I love that.
Right? Show up passionately. And I've learned that the bright light often has a way to find things in troubled worlds. And I would suggest the real estate climate has so much change involved today that bright lights are often our best friend. So today's visit about real estate and opportunities, I'm so tickled.
We're tickled too. And love that approach you're taking about the bright light, because so many people, I mean, they can be, high achieving, successful people. When they're dealing with mortgages, it's scary and overwhelming and confusing, but it just does not have to be. It doesn't have to be scary or daunting or any of that, right?
It doesn't. I don't remember growing up in school. I don't remember taking the mortgage class. I didn't think they offered that one. So I think that we're just born into the life we live with the understandings of not so much. So when we're presented with home ownership, the dream of being that homeowner, but using their instruments, it is challenging. In fact, I won't ever forget my first. I was refinancing a condo I bought. I was in San Diego. I had a mortgage folder. And it was from the bank. It was from Chase Bank. I'll never forget this. It was legal size documents. There were 5 pages in these legal size, and it was all about filling in the blanks. I was so overwhelmed. There were so many questions, and they were really personal. They were honestly pretty uncomfortable quickly. And as a consumer at that time, I was overwhelmed, and thank goodness I was holding that folder in my hand because her name is Peaches. And Peaches came in the elevator, and she's a mortgage broker. And that was the day I discovered what's the difference between the mortgage bank and the mortgage broker. Okay. Peaches says to me, she goes, Scott, I see you've got a Chase mortgage package. Peaches, I'm trying to refinance my condo in San Diego. And she says, Scott, don't you remember? I'm a mortgage broker. I can help you. And I immediately said, oh, Peaches, thank goodness. I'm so overwhelmed with this package. I don't know what to do with it. Scott, I'll help you with everything, she taught me. And that was when I discovered when you work with a mortgage broker, they're focused on your success. When you go to a mortgage bank, they're focused on their success.
Yes.
So you don't have to do financing that nobody taught you how to do it. You don't have to do it alone. That's the difference when we work with a mortgage broker. I've discovered their fiduciary is to the consumer's best benefit, but a bank's fiduciary is to the credit providers and shareholders that support the bank's operations. It's a completely different approach. And I've learned when life is troubling, like taxes, well, don't do it alone. Get a CPA, get an expert, where all they do is focus on to make that behave well. And well, that's the mortgage brokerage world, is why I love being a part of it. It was how
Well,
I
we
set
talk
my
about that. We talk about that a lot, Regina, right? Like how
Yes.
important the relationships you build in a real estate transaction are so important. Find people who have your back and who are looking out for your best interest. Yeah, we all have to make our money, but the best way to be successful in your field is to really look out for your clients.
May I please, and wouldn't you agree, Regina and Brooke, that the number one strategy right now in real estate is relationships?
Of course.
When we're walking in front of the house that our consumers most likely are falling in love with, there's a great chance they're not alone. There's a great chance in this climate with such a short, tight inventory market that there's going to be competition also writing their version of offer. Here's what I've learned and discovered. As sellers and listing agents are reviewing the offers coming to them, part of what's getting reviewed is not just the offer itself, but the person who wrote it. Who's the agent representing the want of this buyer? And do they have a history of yesterday successfully closing? Or do they have a history in market that's not terrific? I've learned it's the reputation of the agents we partner with that matters so much. And that even involves lending. So if there's a mortgage loan involved, when we work with large banks like Rocket Mortgage or big giant call centers, here's what I've discovered. I've discovered great communication is a great way to win anything in life, especially real estate. And that a listing agent reviewing a multiple amount of offers, including cash sometimes in this climate, great chance it's there, they're going to review who's behind it. Can I communicate easily with that lender? Are they easy to reach? Do they have a history of closing loans successfully? All of those ingredients matter when inventory is this tight, because the seller often gets a broad amount of choice to select from. So I agree. I suggest that the number one strategy anybody can use is partnering up through passionate folks of industry that are significant in making a difference. That's how we win.
I love that. Can I toss a question your way?
Please.
So something that I'm dealing with a lot right now in real estate, the vast majority of my clientele are wanting to do contingency offers. And a lot of them, the vast majority of them are coming in from out of state. And so they're saying, I don't want to put my house on the market until I find my dream home. Oh my goodness, thank you for helping me find my dream home. It ticks all of my boxes and meets all of my criteria. Now I'll go ahead and put my home on the market.
Yes. Yes. Exactly. I love it. Those who aren't able to see us. Oh, I love your eyes going back and forth trying to find the solution. That's not
so it's really difficult in our situation to construct an offer and put an offer together. Let us buy your home. Also, they want to come in with asking for a lot. And so we're constructing our offers and we're doing the best that we can. From the mortgage perspective, what would your advice be to educate our clients?
Allow me, please.
Thank you.
Allow me. And I love that you're highlighting that. It's almost like the chicken and egg story, right? The chicken or egg. Do I sell my house first so I'm positioned to be successful on the house I want to get? And if I do that, then the question is, will I find the house I want? And then will they accept my offer? And now I'm homeless. So I can see why we would want to secure the new home we love that they said yes to first. It's better to know our exit strategy before I create the exit strategy, so I know where I'm going towards.
Of course.
And so I see the why they want to do it. But in today's climate, and I think in any day that we're being listened to, the story stays the same. So today's climate, I believe that we as consumers qualify for the houses we have or the ones we're departing from when we purchase them, probably to get into the community we wanted to be a part of. In today's climate, we probably got to prove to what our income allowed us to own.
Yes.
So for many of us as homeowners trying to move to get our next home, the obstacle becomes this for many of us. The reason why writing a contingent offer is because the loan that I'm going to acquire the new house with has to be approved. Part of a loan's underwriting approval has to review a homeowner's debt. So when I'm reviewing debt, I'm taking a look at the debt that they currently have. And this story is a story about them owning their home still, not yet sold. So I must take into account the cost of that home ownership, taxes, homeowners insurance, everything involved as it relates to their story. And then we're asked to adopt the cost of the new house they're acquiring. And so when I blend that for many consumers, all of a sudden I exceed the amount of their income's ability to borrow all of the homes at the same time. And of course, most don't want to carry them at the same time. They do want to sell it later. But the loan isn't able to be done for many in that environment because the income earned most likely may not be enough to cover 2 homes at once. However, if it is, then that obstacle is not that home buyer's obstacle. And they most likely don't need to write a contingent offer, and they can focus on the house they're falling in love with and allow the other one to be disposed of afterwards. And I think we're talking about now the consumer that we just described that apply for a home that they can't carry 2 at once. So we're going to stay in that spirit, if I can, with the solution of how you can do it differently.
So most of these people also are retirement age, and their thought process is we're going to sell the home and we're going to use it as a cash. We're going to buy the next house in cash.
Well, there's that person too. That makes a lot of sense, Regina. There's that moving
Okay.
out of state to Texas is so magnetic, so many people coming. So you're saying retired people wanting to transport cash and to get it too. You know what I've learned right now? I don't think we're really buying real estate as much as we're winning it or losing it. And I think we're meeting buyers that hope to win it. So we're talking about, I want to do this and then I get that. I've learned in life, I don't get always my cake to eat it too. I've got to focus on my actual end want. And what I'm hearing is a senior who wants to retire into a home and then sell and then transport that money. So allow me this. That's one version. But I love your question. Now, I have no idea who's hearing us, and I don't think everybody's going to be a senior. So I'll speak in a broader sense so that we can affect more. So when I think of that, and it includes a senior in your scenario, but what's amazing is those that retain their homes. I don't think all of us think. I think many of us think that the program is to sell to get, because that's what we usually do when we move up to a new home or a new community. Somebody told me a long time ago, I wish I was younger earlier when I heard this. They said you can get rich by buying and selling real estate, but you can get wealthy by retaining it.
Yes.
I've discovered we don't always have to sell to get. There's so much abundance of equity. Wealth development comes through retaining real estate, not necessarily releasing it. So what if instead of selling it, what if instead we as that homeowner tapped into some of that available equity that most likely lives in the homes that we own in America? The majority of homeowners in today have an abundance of equity because of real estate's growth being so powerful. So depending on when you bought your home and what you owe, who's ever hearing us, there's probably an abundance of equity that there's mortgage instruments that allow you to unlock that to cash.
Yes.
By doing that, you could take lazy equity in this moment that would be converted to cash when you sold. But I'm suggesting, what if we kept? What if we kept and we rented? And what if we used like an equity line of credit, for example, and transported a portion of that equity from the house in Iowa that I want to now move to Texas in my example? I could transport enough to create a down payment. And in this story, I'm going to choose to rent the Iowa house. So what if I chose to do that and worked with my local realtor to find a tenant? And now I have a tenant to lease my home. When you go to buy your new house with you in Texas, for this example, as a lender, I can now use the rental credits that the lease is now in place to provide your buyer in Texas with once they move out. I can offset the mortgage debt that belongs to that Iowa house. So now you can qualify on your house without any need of any contingency offers. And that's a story of retaining real estate and adding a portfolio. And there's another way. So for those that have, for most Americans that have mortgages on their houses, most of us are going to have a Fannie Mae or a Freddie Mac mortgage. Those mortgages, Fannie Mae in particular, created a wonderful strategy just a few years ago that answered this question nicely. Allow me, since we've got a broad listening audience. If you're a home buyer looking to get your home in Texas or out of area, moving out of your home, and you are selling your existing home not yet sold, and you'd like to try to write a non-contingent offer, and you're in a hot market that you've got a willing buyer waiting to get it, in the world of Fannie Mae, as long as the buyer that's buying your home has removed their loan contingencies and created those, I'm now able, if we're using another Fannie Mae mortgage, to offset the debt that lives on the house you're selling because you're in an approved sale and that buyer's removed their loan contingencies. That's another way of approaching before that other house sold.
I like it. It's very
That's just another way. There's another way. Because you asked me to speak through a senior's lens, so I'll do it now. Did you know that it was a handful of years ago, it was 2008. Most of us are not familiar with what's called a home equity conversion mortgage. A home equity conversion mortgage is an insured mortgage that only becomes available to you and I once we turn 62 or older. So it's a solution designed to protect and serve seniors, the future of our tomorrows. They get different tools as we start to retire forward in life. A home equity conversion mortgage for the first time is able to be used to purchase new real estate. So there could be a potential that the example you just gave me, Scott, they want to pay cash for the new house. And I'm assuming they want to pay cash because they don't want to have mortgage debt commitments. So what if we used a home equity conversion mortgage to buy the new house with? A home equity conversion mortgage is amazing. What it invites, it's a loan solution made available through the Federal Housing Authority, FHA. So FHA insures and creates this home equity conversion mortgage, and its invitation is to be able to have a mortgage instrument that requires no monthly repayment. That monthly repayments are made by choice, but not by requirement, allowing them to have the new house they want to buy with no payment, just like they wanted to use all their cash for. You know what I've learned? As we age forward, I'm aging forward. Getting out of the car is not as simple as it was just when I was younger. I mean that. And having money in my bank account, especially in this high inflationary market, I bet is a safe space for a retired individual to put their money. Tomorrow could be something I didn't expect. And having liquidity dollars in place to speak to it is going to be a more comfortable resting that night for that senior. So Absolutely. If we're a senior, as you described, I would recommend examining the power of what a home equity conversion mortgage can do, because it can provide a solution through a revolving line of credit. Okay. So that if your senior sold the house instead of retained it out of area, they could now pay off that line of credit completely. There'll be no interest in acquiring in the background, but they can access it later in case life gets unknown. You see, what I love about a home equity conversion mortgage protecting a senior is that not only does it at a federal level insure risk, but it does it in a way that doesn't happen for you and I until we turn 62. And it was because of the past. So much elder abuse over the years of the befores have brought enough reform on a federal level that became significant. Most of us don't even know what that was yet. So speaking about this now is an invitation to learn. And a home equity conversion mortgage ensures on the federal level that that homeowner can live in the home they have for as long as they live life. In the olden days, there were triggers and would force them to buy down what they borrowed. Not anymore. The federal government will protect that homeowner, and you will live in that house as long as life will let you live there, regardless of value, regardless of anything else that happens. That's an amazing protection. And the heirs, the people that go later that you're going to give the estates to, they'll never, ever get a chance to adopt negative equity. Instead, because of this federal insurance policy, the heirs that are to achieve the future story have a chance to buy that home if it's negative equity. Let's say there was like an earthquake or something bold happened that shifted the markets in a big way. We were all there in '08. Life can happen. So let's say that life happens. It did before. When those FHA insured home equity conversion mortgages are presented to challenges, the federal government guarantees that the heirs can get that estate for 95% of the current value. So if you borrow 200 and it's worth 100, you can have it for 95,000. The federal government will pay the variance. There will never be negative equity for the heirs. It's the most powerful loan I've ever seen insured, but on a federal level. And most of us don't even know it exists, but it would solve that problem. And then,
Incredible.
isn't that delicious?
Well, what's so great about all this is that there's almost always a solution to every problem. If you're working with the right people, they've got something in their toolkit that's going to help you find a solution to the situation you're in. Real estate varies drastically from transaction to transaction, and you have to have people like you who are wicked smart, who know, hey, let's figure out a solution to this. And you can find one. That's amazing.
Isn't it true, Brooke? You know what I've learned? So 2007, it was August. The secondary markets shut down for the first time in our human history. It had never happened before. And the money stopped. So I won't go down any rabbit holes, but please. In mortgage banking, the topic we're reviewing today, money has to move. So a mortgage bank or a bank funds a mortgage for a consumer to finance real estate, and they fund several for a given period, let's say a month, but they're doing it off of a line of credit, and they fund off of a line of credit. They take the loans that they had just funded for their qualified buyers or homeowners, and they sell them to end investors. They get their initial profits and they're able to reset that line of credit, and the money keeps recycling. And that is how mortgage banking works. That stopped behaving in August of '07. In February of '08, Fannie Mae and Freddie Mac were taken over by the federal government. The federal government told every existing lender that was still left in the market that if you lend to our rules, we will buy your mortgage. So money could continue to move even though there was no secondary market to take these loans to. So almost all of us in America have been living off of the federal government loans since 2008. Most of us, and they're still owned by the federal government. I say it all on purpose because here we are in 2023. Such a better time. Well, you know what? It took a long time to get here from '08, '07. But the now moments is that there's a reactivated, that secondary market that shut down is reopened again. And that's an invitation for building solutions that have nothing to do with the federal government's requirement to buy the loan through their guidelines. So there are solutions that are being built right now, Regina, that help to answer your question even more than what I did. Allow me, please. Here at our brokerage, Scott Griffin Financial, I'm in Los Angeles as my primary focused market. LA is a very competitive city. Even getting a parking space is competitive. Inventory is our problem throughout America. There aren't enough homes to buy for those that want to have them. And in LA, in a lot of pockets, it's a multiple offer. And it's that same question you had, Regina. How do I get the new house when I haven't exited the old one? So we've worked with some of our investors, and we literally launched 2 years ago a solution that I found so powerful. And in your local market may have one that could look similar. I'm not sure. But here in Los Angeles, California's market, here at Scott Griffin Financial, we built what we call the Move Up Buyers Program. Well named. Here's what it does. It allows us to order an appraisal on the house that the homeowner currently owns. On the appraisal, we order a market survey. It tells us what market rents would look like if this homeowner decided to convert this to a rental. I spoke earlier about using the solution of converting to rental, but I said you had already had a lease agreement. The move-up buyer program doesn't require any new tenant. It just requires the appraisal with the market survey that will tell me what rents can look like when you move out of your primary home. And now that becomes non-primary because the replacement home now is the primary. You invite me through this solution to offset the mortgage debt that that house currently has by using a portion of the rents that the market survey told me. And I use that to offset the debt. I often bring an equity line of credit on the house that they currently own because most home buyers say to me, Scott, that sounds wonderful. You won't look at the debt, but that's where my down payment was coming from. So since there's such an abundance of equity, we combine it with a home equity line of credit and we transport that over to the new purchase money loan, and they're able to get it with no contingencies at all. And since we pre-underwrite everything up front, we removed a lot of questions relating to risk, and we invite our home buyers through this solution to close purchase money in 10 days or less. And that's how you win in competitive markets. You become rather magnificent by finding passionate people that show up to help you to do it.
I love that. Yes.
Yeah, that's fantastic. And one of the things that you keep hitting on is you're going to build wealth, and hopefully the goal is to build generational wealth through the proper management of your real estate portfolio. So I love that you keep touching back on that. And as I mentioned earlier, maybe I did, I really like working with first-time home buyers. So I love kind of you came into this with don't overextend yourself when buying your home. And I really try to educate my first-time home buyers, don't buy beyond your means, buy with the plan to hold on to this property and not have to sell it when you're ready to move up so that you can start building wealth through your real estate portfolio. So I love that you keep coming back to that.
You're giving me goose pimples. I love that. I love that you're just saying it even clearer because it's true, isn't it? The first one's the hardest one. Once you own the first one, well, now you get to play with equity. Equity's fun to play with. You can't play with it until you have it, and you get it by buying it first.
I wish that I still owned my first house here in Charlotte. We've had a big influx of people coming here during COVID. You know, you can work from anywhere. And Charlotte, North Carolina is very close to the mountains and the coast and halfway between New York and Florida. So it's a really desirable area, big airport. So a lot of people moved here from other areas and drove our prices really high. And which is great for people who are first-time home buyers and hopefully put them in a position to be able to retain that and sell. And I wish that I owned my first house, but I didn't have somebody like you who had creative solutions to help me. Okay, let's try and figure out a way for you to hold on to this house so you don't have to sell it, to use your equity to buy the next one.
Exactly. So and I'll take that one step further. I love what you're saying, Brooke. And you know what I love even more? The timing of our visit today. So I'm like you. May I please? I love first-time home buyers. It's really true. You do build wealth by owning real estate. Unlike any other instrument I think we can invest in, real estate does things differently. It allows us to borrow against it. It allows us to rent it, give it away, sell it. There's even get tax deductions from it. There's so much invitation that wraps around the storybook of real estate itself. Allow me, please, Brooke. I have a feeling that the obstacle for a lot of first-time buyers is the same in most communities. I believe we stay renters longer than we should be because buying real estate is expensive. Renting an apartment or renting a home, often they ask us for our first month's rent prorated and a security deposit. And if we don't have enough credit, maybe an additional enhanced security deposit. That's a different type of number than a large down payment. And I think for many of us out there, we get stopped because we don't believe we can yet, because we believe we don't have enough of whatever they're looking for. Remember that mortgage class nobody took? Well, exactly. So most of us just think it's 20% down or 10 or some other number I don't have. Well, I love education. I love what we're doing today. We're educating, we're sharing stories of how you can, because the truth is you probably can. And you were just waiting for somebody to share it with you. So let this be that. So may I please? I love
Mhm.
timing. So here at Scott Griffin Financial, my focus is like what we're talking about. It is first time home buyer success. Now, I don't know how you become successful if you don't understand the obstacle you can cure first. There was a program here that you may have heard about. It hit national news in California, where the state of California was giving away down payment assistance. And there was so much assistance provided. They had a lot of funding for it, like over $300 million. It was absorbed in less than 8 business days, completely disappeared, all used up. The demand for ownership is massive. We know this. We just don't believe we can because we may not have a lot of dollars. So here at Scott Griffin Financial, we worked with our partners, and just right this week, it's an awesome week because we just launched First Home Plus. Literally the very best in my career that I've seen that speaks to yes, that really creates a solution to let you have a house. Here's what it is. It invites a California, Los Angeles, Orange County, or the 2 Southern California counties. So I'll speak through that lens that this is doing. It allows them to buy with 1% down. 1% down is a much easier number to measure. It feels like a security deposit. So right? But that's not the only help we get. Not only is it only 1% of our money, but this solution, First Home Plus, provides a 2% grant that goes along with your 1%, creating a 3% down payment. But the grant, well, it's silent. There's no interest and there's no repayment. In fact, it goes away as 100% removed after 3 years of on-time payments. So
Wow.
it's a fancy way of saying, here's the help you hoped you could have. In fact, make a difference in your community, be a homeowner and make payments on time for 3 years. And you don't even have to pay this portion back. It's yours.
Oh my
Not only is
goodness.
that, there's no mortgage insurance, completely removed. No upfront mortgage insurance premium and no monthly mortgage insurance premium. And in today's current environment, what I've been reviewing is how does the solution stack up against the other choices a first-time home buyer would most likely utilize. Here's what I discovered. It's so beautiful. It won each time as it answered, how did I help? Here's how it won. It removed the need of the high cost of down payment. Fannie Mae and Freddie Mac for a first-time buyer allows most of us to buy with only 3% down. But 3% of $500,000 might be a number I don't have in my bank account, but I might be able to get 5,000. So already you're creating savings, but it wasn't just there the savings lived. When you entered their minimum buying, like 3% down at Fannie Mae, first time buyer, well, the interest rate was the highest they had available to borrow because it was the riskiest loan that they have designed to offer. So not only was the cost and the rates you pay much more significant, but so was the cost to even achieve the loan. And then when I included the mortgage insurance premium, the savings that First Home Plus provided was significant upfront and every month thereafter. And then I looked at the other choice, which is FHA we use. Well, that one invites us to put 3.5% down. You know what I love about FHA? It's the government's way of spelling yes. FHA is a way of saying yes, I'll help you where others wouldn't. I love FHA being a solution for many of us getting our first homes. However, yes comes at a price. Now, it really won't be an interest rate because there's a strong likelihood the interest rate will be lower than Fannie Mae's interest rate because it's federally insured. However, FHA insurance requires 1.75% of your loan amount up front as an insurance premium. Most of us don't have 1.75% additional, so that gets financed in the loan. So when you start comparing the other choices we use, the savings stacks up at a significant level, no matter how you look at it, entering the home or paying for it monthly. And in First Home Plus, since there's no mortgage insurance, that means more of your on-time monthly payments are going to your tax deductions, because mortgage insurance is expensive for some and it's not tax deductible. So why is it there? Let's get rid of it. So First Home Plus did that. And it's did it because here's what it's wanting to do. Here's what we want to do. Communities become stronger through the homeowners that make those neighborhoods theirs. And there'd be some wonderful people in these homes if we could just give them a helping hand. So how do we interpret that? Well, Southern California is expensive. So we believe those that earn $109,000 and less, it sounds like a lot, but when you take that income and put it into LA's math, it's often not enough to get a house you can live in, not with everything else, and not enough to save. So we say if you earn 109 or less and you're in LA, we're going to give you access to this solution, getting the house for 1% down, no mortgage insurance, free grant money. Just go get a home and start winning next. But
Scott, yes is so powerful.
Right?
The first step, and the ripple effect that it has throughout the community for those families investing in those schools and the small businesses. And it's just the far-reaching effect of that one yes. It's fabulous. That's fantastic.
Brooke, that's so well said. So well said. You help one family, has such a rippling effect throughout all of the spaces, and then you affect others. And I've learned that we take action as people when we see other people winning. I think that we see it when others do it. And so let's be witnesses for people to let them know they can. Man, and if your home's in a community that is zoned by the federal government as a census tract, then there's no income limit. And so it's fun to help when you're bringing solutions that matter and become significant. Now, not all of our listeners today are living in California's market, so that solution may not become theirs. But what I recommend is to check with your local state housing finance authority. Now, not every state has one, but many do. Housing finance authorities are designed to create solutions for their state and cities to get first-time buyers into those homes. They do it by lending money, by doing some other tools. They're little intricate, but they're a way of how you do it. And a mortgage broker is a great way of how to find them. Wherever our listeners are hearing us through, I recommend find a mortgage broker. Allow them to guide you down the path of what today can look like. You see, when we go to a mortgage bank like I did before I met Peaches and I went to Chase Bank, there wasn't any advisement provided to me. Instead, it was a folder with all of their marketing material and the application with a checklist of everything I had to put together that became so overwhelming. But there wasn't the hand-holding. It wasn't the path guide. I didn't get a pathfinder that led me down the path of yes by any means of the word until I met her, until I met Peaches. And then all of a sudden I've learned it mattered.
I've got a client right now. I'm on the seller side, but the buyer was with one of the big banks that you've mentioned here today. And he started with this small mortgage broker, went with the big bank because they flashed a nice interest rate and everybody's looking for a good interest rate now. But then he had a conversation with the broker that he was with to begin with. He said, do you mind if I look over the loan package? And yeah, the interest rate was a little bit better, but all of the hidden costs, the loan origination fee, everything else was just thousands and thousands of dollars more. And I love that you say Pathfinder. I love that. He would not have had that Pathfinder. And there have been instances in this transaction where he needed him as a Pathfinder.
I love that. I love that so much, Brooke. Yeah, again, we're back to that same thing, that mortgage class we never took. Nobody ever taught us how to read a loan estimate with clarity. Now, we have, you know what else is interesting? I love to ask people Their familiarity with the SAFE Act. So the SAFE Act was born to redesign the market that wasn't working before. And they're all consumer protections. And most of us can't even explain what it is, didn't even know it exists. And they're there anyway. The market shifted so much. And most of us that aren't paying attention, that went to work, who are at work, those are the people that are learning on the Zoom meetings. They're not paying attention to, most likely. It might be on Facebook, everything else. And so that's where they're grabbing their education from. And then you find these oddballs over here that don't even know they're working. And they're not only paying all attention to what's out there to learn, they're even Googling the stuff nobody told them because they've got passion to understand it. I think it's passionate folks like that that brings so much strength to why a mortgage broker is such a significant partner when it comes to financing real estate. And why did an industry get developed that all it did was focus on one instrument? It's all it does, but it does it better than anyone else because it's all we focus on. There's no auto loans, no credit cards, no checking accounts, no CDs you can buy. One instrument, but we do it better than anyone else because we hyper define only on it. When you step into that moment, it's a different moment to be a part of. And lending through the lens of they didn't teach me is a hard way to do it comfortably. It's nice to have a pathfinder.
I love that. I've never heard your profession described that way, that you are hyper focused on that one instrument and not everything else. I'm going to steal that from you. And you
Please.
Sorry. That's my Scottism. I'm taking it.
I love it. Yay. Yeah. Well, and it's fun to get that type of experience to be your friend in a world they didn't teach us about. Because like you taught me about that person that got the review of the documents. It's like going to buy a car, isn't it? Why did my mind just see the car salesman? And why did I see how they wrote on the four corners, the down payment, the paint? They confuse you. And they focus on the thing they know you're looking at, monthly payment. But if you get to this, isn't this what you wanted? But all these other areas are there also, but I don't know what those are. Look over here, right here, the interest rate you asked me about. You wanted that one. They didn't tell me about the origination points, the discount points, the other fees that invited that interest rate to be present. We all know nobody's giving money for free, but we often present the money differently in a way we hope they'll hear us. And we can do that in lending through different instruments that they didn't teach us about. So I'm not surprised when you share what you just shared with me in that buyer's example of the difference between advisement and fulfillment.
Mm-hmm. Well, one thing I learned recently, I learned from Regina. She's got a great line about interest rates and homes. And so, yeah, you can have a great interest rate, but if all of those other fees are involved and, the end result is just in the interest rate, big deal. That could be changed. What's your line about interest rates, Regina?
Marry the house and date the rate.
Yeah, and divorce the landlord.
Yes, and divorce the landlord. Yeah.
That's not my original line. I just use it every day.
I love it. I love it. You know what, please? So home ownership, we're talking about how amazing it is. Some of us don't even see ourselves doing it because it feels like it's their story, not our story. Hopefully what we're talking about today is inviting people to see their version of their story, because the chances are you sure can. And I just love that. When I think about interest rates, here's what I think about. It is so interesting because sometimes a higher interest rate is better than a lower interest rate. And it's for the reasons we're speaking about. Everybody's goals for the houses they have is unique to the people buying them. So that story about one size fits all, it's not true. That robe does not really fit everybody, even though it said it did. Mortgages are no different, right? And so here's what I mean. Sometimes we step into our first home as a stepping stone to another home later. Sometimes we're going into a community because education is there, and I'd rather own during education than rent during education, but then I might sell after my education completes. Everybody's goals belong to them. So to achieve a lower rate and lower payment, there's an exchange, and it often means that I'm going to pay a higher cost up front for that mortgage. Something has to give for me to get, one way or the other. So when I look at a higher rate and saying that sometimes that could be better, well, It can, because higher rates often mean lower cost. So there's often an exchange for a higher interest rate. It may, in exchange, offer a lower cost to enter the playground. If you've got a mortgage that you don't intend to keep for 30 years, then why would my focus today be on trying to get the lowest rate humanly possible? I suggest that we're in a market that is history making. We got here through inflation. We got here because inflation went the fastest it's ever gone in history. The bond market is what controls mortgage rates. The bond market's kryptonite is inflation. And since we have the highest inflation, you can imagine what's happening in the mortgage market. Until last year, the federal government was buying most of the mortgage-backed securities in America. They stopped. So now we're reliant on just the regular market buying it. And now we're in this inflationary pressures. That's why interest rates are really shifted right now. Those are some of the ingredients of why we're here. So as I say that out loud, there's a suggestion that once inflation tames and makes a reversal and it goes down, well, then so shall be the interest rates. Now, if that's true, and you're a homeowner who's going to have your home for a while, one might suggest that the mortgages we use to acquire the houses today are some of the mortgages we'll refinance in the future when the markets make a correction if it invites us to. There are so many indicators that suggest the possibility exists. And if it were to be true, wouldn't it have been a shame if you invested so much money in that initial mortgage that you're able to reset now for like 1% lower or 1.5%, whatever, however lower it is, and you want to do it, but you just spent all that money to get the one that's even higher? I suggest we're in an inflated environment right now, and the lowest rate may not always be your best solution. Work with an advisor that will educate you on the things nobody taught you about so you can see what fits your needs correctly. And that's the difference of what happens when I go to a bank or a mortgage broker.
Very,
Yeah,
very
that
well
education
said.
you say none of us got. I think in real estate, it's the onus is on us to provide that education for our clients, and for us to stay as knowledgeable as we can and on top of the ins and outs of our industry so that we can be that pathfinder. I'm going to use one of yours again, the pathfinder, to help our clients find the best solution to their goals.
I mean, look at both of you putting together this opportunity for people to learn through. Talk about passionate leaders of your local industry. You two ladies are so passionately powerful, making such a difference. And it's a choice. That's what we said earlier, right? Some people are at work, some people are going to work, and there's these silly people on this meeting right now. We don't even know we're working. That's passion, that loves to win. That's who you need to look for. When you're looking for a friend to help you win, look for passion first.
Yes.
Don't you think
that.
real estate is just such a great way that every person can, and you can change lives through real estate? I mean, a home ownership it feels so good. That sense of community you were talking about, and that pride, and yes, I can. And then they go out and encourage others, and we get to be a part of that.
Oh my God, I'm getting goose pimples again. You know why? May I please?
Please, please, Scott.
I think it's why I love this so much. We get invited to meet people when their want is highly activated. I love the power of want. I love what happens when we get to say hello to somebody who's activated in their own personal successes. And then we're invited to be with them on that journey and that piece that's so meaningful, so different than just asking what you'd like to eat this afternoon or whatever else we might do in life. This is a different life event. And gosh, I don't think it ever becomes unemotional. Now, I've been doing this since 1997, not forever, but please, I'm not immune to emotional feelings during my own real estate transactions. I refuse. You know that story, just because you can doesn't mean you should. I'm a licensed California broker, real estate broker. So I can list, I can sell, I can represent. I dare not. I'm an expert at lending. I hyper focus on it, not the other pieces. I work with professionals. And I've learned that when you want something wonderful, simply don't do it alone. Get an expert. And I practice what I preach. Because real estate is emotional. And there's so much that we don't know, even that we don't even maybe know to ask. And that's the gift of seeing real estate through your eyes, for example. I'm confident that when you guide your successful buyers and sellers, is through advisement. Here's what it is, but here's why the what is present. I think a lot of people in the industry only speak through what, and they forgot about sharing the why. And I've learned it's hard to understand if I have why unanswered. So I think that's what passionate people do. They don't just say what, but they say why the what's there, if that makes
Yeah,
sense.
why is very important. Yeah.
Don't you agree? Why?
I do. I do.
Yeah, I
And
love it. I love what
Regina,
you two do.
I have
Regina
so
and
many
Aaron have a great approach with their clients. That Aaron's not here with us today, but Regina and Aaron work together in their business in San Antonio, and they have said something very early on when I met them that really stuck with me. When they meet with clients, it's as if they're dating them, because they want to get to know that why. What are your goals? What are you, not just this quick, okay, let's find you a house and get this closed so I can move on to the next one. They create that relationship and really look out, okay, this is going to be long term. This is maybe their first time home experience. I could be working with them for years and years and years on other transactions, and they invest that time.
Well, and then their family, their friends, their work colleagues, it spreads. And
Quickly.
so the relationship is very vital to us. But Scott, I would love to ask you a little bit about the debt to income ratio that's important.
Please, I love your question. So debt to income. So when a lender underwrites to the word yes, they've got to answer some questions. A law passed through that SAFE Act I spoke about earlier is called the Ability to Repay Law. This is important to know about. For any home that we're going to buy that we intend to live in, any lender that makes a loan to that type of consumer must validate by 8 specific steps their ability to repay that mortgage. Nobody gets to skip it. So that's very important. Part of how we answer if you can pay it is that we look at all of your debt. So debt, credit cards, auto loans, student payments, commitments that take your money out of your wallet and puts it into somebody else's. Any form of debt that happens with, even if it's debt that's not on your credit report. So debt, even looking at the new house you're buying, not just the mortgage payment, but that house has property taxes. It has homeowners insurance. It has things that will create debt. So we're going to look at all of the debt that you would take on after you became that homeowner. And then we're going to say, how much is that debt against all of the income you bring in? So we call that a debt to income ratio. So debt to income, for many of us, thank goodness, technology is so smart. It's all the years of algorithm development that makes it smoother, faster, better. Well, when it comes to underwriting risk, most of us are going to use a federally backed loan in today's climate. And we use automated underwriting. Automated underwriting uses technology to make credit decisions rapidly. The debt to income it allows a consumer to have is now based on a multitude of measurements that relate to the consumer. So one consumer may be able to use, let's say, 43% of all of the income they have to speak to debt. But then another buyer looking to buy that same house, they might be able to use 47% and get approved where the other one didn't. But I'm looking at the same house. And that's because everybody's an individual. What money do I have left over after I own the house? What credit score did I have when I applied to get the house? There are so many questions that get asked that help to answer how you get to do it. Debt to income is such an important piece to that. So debt. When we look at the debt, when we're thinking about home financing, you can imagine that you as the home buyer will be better benefited by not adopting new debt. The less debt we have, the better we're going to be at getting there, yes, because more of our income can focus on the house not on a car or an auto or something else. So that will empower you. May I please, when we go to buy a home and we exceed what they call their debt to income level allotment, let's say they allowed me to use 45% of what I earn. In the house I found I'm at 46. Well, that doesn't mean you can't have it. Remember that mortgage broker you were working with? Well, guess what? They're going to be able to do differently for you other than say no. They're going to review your credit and they're going to find an opportunity to reduce some of your debt. And while you're in an active escrow, I can rescore you. So I can take your credit report and I can take data that's no longer accurate and make it accurate to right now. Normally, we have to wait 30 to 45 days to update data quickly in a credit. But when we're in an escrow, I can do it in less than 5 business days. So I can go from no to yes rapidly if we get stuck in an income level. And so can you by reviewing the debt that's being looked at and seeing if you have the ability to reduce the debt. Sometimes we're empowered by taking the debt, paying it down instead of making a larger down payment. Maybe I'll take down payment dollars and make those debt reduction dollars so I can get to yes. Life has creative paths, but the debt that we carry in life is what they're going to measure first. And everybody's version of how they're going to be looked at depends on how you started hello.
Yes, that makes perfect sense.
I love this has all been focused on finding a way to say yes. And I mean, that's what this is all about, right? Yes, so that your clients can find that pathway to home ownership so that they can develop wealth and make a change in their life and the lives of future generations. And it just amazing what you're doing and the passion that you bring to it.
And you're so kind. And Brooke, may I please, since we both share such a strong passion to help first-time buyers succeed, allow me, please. Most of us listening, I'm going to guess, are not yet familiar with a term called trended credit data. This is going to be something you're going to become familiar with. So I want you to be educated earlier instead of later. So thank you for listening to us. Allow this to be our gift to you, because you're going to find this as a very strong gift as you enter home ownership some point today or tomorrow. Trended credit data allows a mortgage underwriting decision to happen differently. When we make underwriting decisions as an industry, we use credit scores so strongly on how we estimate your ability to repay that loan. You see, a lender has one master question I've discovered. And here's the master question. Will you pay me back? I have to ask a whole bunch of other questions to get to the master question. And so as I think about that, and I think about will you pay me back question, I think about ways of how you pay back. And so allow me, we're able to win in today's climate in so many different ways. And educating first-time home buyers on trended credit data is how underwriting through algorithms is going to look at us. Credit scores were built in the 90s. I thought they were here forever. They're not. And credit scores, there's over 30 different algorithms used in the market space. Real estate uses one specific one. So our credit score that we underwrite to has a different look than the one you most likely get from your credit cards, just a different algorithm. But allow me, the credit score is no longer the only thing that we're going to make credit decisions on. Here in the near future, you may have a 700 plus credit score and get denied a mortgage. The reason for that is that a credit score is easy to manipulate. A credit score is simply a photograph of raw data at the time you ran the report request. I like to think of credit like a river. It's never the same twice. And that's because credit cards are not always reporting information at the exact same time you used your credit card. Maybe you went to lunch today and I ran your report tomorrow. Maybe that lunch was $32 and it was enough to affect your FICO, but yesterday you didn't buy that burrito. So everything we do in life has an effect, and we'll see it in the credit report. And if you pay down credit, once I see it, then I can often improve your credit score. So that's what I mean by credit scores are easy to manipulate when you understand what they're looking at. Trended credit data removes the manipulation. So here's how it does it, and here's what it's doing. It focuses on revolving credit cards, and it wants to know, how do you manage debt, consumer, and your credit cards is going to go back 2 years. 24 months history is what it's looking at. We've not done this before as an industry. We do it now. We're looking to see, what was your credit limit? What was your credit balance? What was your minimum payment required? And what payment did you make? And so how you manage your revolving credit will, in the future, very, very, very soon, determine whether or not you get a Fannie Mae, Freddie Mac, or a mortgage. Because we're going to use trended credit to see if you're a credit abuser, if you're a credit user, or a low credit user. We're going to get a better understanding of your credit past by seeing how you manage credit debt. So my recommendation for our listeners today is this. You will be seen as a golden credit angel when you're the creditor or the user of credit making more than the minimum. The people that are going to be most challenged in the future are those that make minimum payments that carry high debt. You are a completely different risk, whoever you are listening to us, than the person that pays more than that they're requested and they don't carry high debt. And if there's somebody that have high debt but they're making larger payments, that's a different risk person that had low debt but is climbing into high debt and not making those payments. So my recommendation for our listeners is to pay $10 more than the minimum. It's not a minimum amount to pay more, just pay more. They're looking, and the new algorithms are looking at that. That's called trended credit data. And most of us don't even know it exists. And we're using it right now in underwriting mortgage risk. So please, listeners, pay more than your minimums.
What a great
Thank you
takeaway.
so much.
No, you're
That's
super
great.
welcome.
That's great advice. I wish we could talk all day long.
Oh, I
know
knew we
all
were going to have fun. Yes.
we were going to have fun too. But that is our time for today. And it has been delightful and so informative. And I really hope that everybody takes away from this that yes, you can. You just have to find the right people to get you there. You might not be able to do it today, this minute, but you can do it. You can get there. There are people out there who will help you find that yes. And one of those people is Scott Griffin. Scott, tell everybody where they can find you.
You know, I love the internet. So please, I'm a national television host on Bloomberg Television as well. I'm also on CNBC and Fox Business. The show's called Financing the American Dream. And it's a really fun place to explore real estate lifestyles and communities throughout America. So you'll find me on television. You'll find me on Apple, Roku, streaming on your local streams. 818-20-SCOTT. What a fun phone number. Who guessed 818-20-SCOTT? Well, I did back in 1997. So 818-20-SCOTT. We'll talk directly. And scottgriffin.com is another fun way to find hello. And thank you again for inviting me today. I love what you're up to. I love what you inspire and invite. And none of this would have been possible today without your inspiration. Thank you.
Well, thank you. And to the lovely Regina.
Thank you so much, Brooke and Scott. Again, Regina Brown here out of San Antonio, Texas. You can find me on all of the social medias. And you're ever looking to buy or sell here in San Antonio, I would love to help you out.
And I am Brooke Bryant. I am in Charlotte, North Carolina. And we talked earlier off camera. Charlotte is the home of the best barbecue, not Texas. So, Scott, you're going to have to come try some barbecue in Charlotte. But it was so great today. I learned so much and can't wait to see what else you're up to, Scott. I'll be following closely, and we'll see all of you guys next week.
Take care. Thank you.
Bye, everybody.